Welcome back. In this video, we are going to look at the stochastic oscillators. The stochastic oscillator is based on the observation that in uptrends, prices tend to close at or near high end of their recent range. Correspondingly, in a downtrend, prices tend to close near the lower end. The logic is that if prices of a stock are constantly being bid up during the day, but if they lose their value by the close of the day, then the rally is unlikely to continue. This is because if sellers have enough supply to overwhelm buyers, it is logical to conclude that the rally might not continue. In contrast, if you see that a stock rallies during the day and is able to hold on to some or most of the gains by the close of the day, then it is a very bullish sign. The stochastic oscillator oscillates between 0 and 100. Stochastic oscillator also has a default 14-day period like the RSI. The oscillator is composed of two lines. These are the %K line and the %D line. These are calculated by the formulae shown here. Here C stands for the latest closing price, while L14 stands for lowest closing price in the past 14 days. H14 stands for highest closing price in the past 14 days. %K is derived by subtracting the lowest closing price in past 14 days from the closing price of the day, and then you divide it by the difference between the low and high price in the last 14 days. We multiply this to 100 in order to arrive at the %K line. %D is just the average of last three %K values calculated every day. You can think about the %D line as a long-term average line, which has to be seen in conjunction with the short-term %K line. This is because the %D line is just the average of the three %K values. Hence, %D line is the slower moving line or the smoother line. Hence, this line is actually called the signal line, because when the %K line is able to cross the %D line, it actually has some implications, and hence %D line is called the signal line. %K is the faster moving line. The %K value means that the latest closing price was in the %K percentile of the high-low range. The default overbought and oversold range for stochastic oscillators is based on reading the signal line relative to readings of 20 and 80. The default overbought oversold range for this indicator is 20 and 80. That is, values above 80 reflect that the stock might be in an overbought zone, and values below 20 may reflect that the stock may be in an oversold zone. But like we said in case of the RSI, you also need to look at each security separately to derive the normal range of values for the indicator. You should look at both %K and %D line relative to the normal range in which they usually trade. If the indicators move above the normal range, then the security may be overbought, and this should be regarded as a bearish signal. However, if the indicator moves below the normal range, then the security is oversold, and this should be regarded as a bullish signal. Like in the case of RSI, stochastic oscillator should be used with other technical tools like the trend lines. If other methods like say trend lines suggest the same conclusion as the indicator, then you have convergence or confirmation. But if they give conflicting signals, you have a divergence which you should regard as a warning signal. Crossovers of two lines can also give trading signals the same way as crossovers of two moving averages. When %k line moves from below the %d line to above it, this move is considered a bullish short-term trading signal. Conversely, when %k moves from above the %d line to below it, this pattern is considered a bearish signal. Let's look at an example of how to use the stochastic oscillator. The chart here shows how stochastic oscillator can be used together with other forms of analysis. Here we see that the security is in an uptrend. In an uptrend, it is common for the indicator to move above its normal range of 80 and signal an overbought situation. But this overbought signal should not be used as a sell signal, because in a strong uptrend, the underlying trend is so strong that the indicator can easily go to the overbought zone. However, in the same uptrend, if you look at when the indicator entered the oversold zones, you see that each time it gave a valid buy signal. So in a strong uptrend, you may rely on this indicator going into oversold zone to indicate that you should be looking to buy. Similarly, when the security is in a strong downtrend, you can rely on this indicator going to overbought zone to signal that you should be looking to sell. Specifically, you should ignore overbought signals from the indicator when it is in a strong uptrend, and also you should ignore the oversold signals when the indicator is in a downtrend. With this, we have come to the end of our discussion on stochastic oscillators. In the next video, we are going to look at another indicator, which is the MACD indicator. So see you in the next video.